the most useful lesson, and it's by I think applicable to anybody. If you lend to your friends or family, you should approach it as a
donation.
You're never gonna see it back.
Are we friends or family? Because then we could decide whether we pay back or not.
And there would be other side would be sort of willing to mess with you.
I already feel like this is going to be the part we cut out.
had it on my mind.
Super awkward moment. We have to start in English, between three Latvian guys. But I don't know. I'll kick off with the question. Juris, first of all, thanks for coming to our podcast. It's our fourth or third episode.
Good to be here.
You've been a creditor to our companies since, I think, 10 years ago, 2010 or 2011, 12.
It's been a while, yeah.
It's been a while, so that's fantastic and appreciate that. Maybe if you could give some kind of an overview of what are you focused now, what's your business, and what you've been busy doing last year, let's say.
Okay. So my business and what I've been busy basically for the last 15 years, actually, maybe even more, is financing companies here in Baltic states. And generally we do it with loans, sometimes with equity investments, but and sometimes in something in between. But mostly it's just loan products.
You mean Capitalia, right? The
Yes.
company.
Yes.
A couple of words about Capitalia.
So it's founded by me in 2008-ish, 9 at the right aftermath of the financial crisis. The funding for companies was very scarce and hard to get by, so I decided to do some experimentation there. Gave a couple of loans out to small loans out to businesses. I think I gave 3 loans out, 2 didn't pay back, and I thought it's a good statistics to do something bigger and more. And that's how it all
that's
started.
Similar to how we started, exactly. Where we are one of your first clients, or did you start with?
You are actually one of, I would say, something 20s, 30s, something in that range. So.
Yeah.
Was it 50,000 at 36% APR?
Yeah. 48.
Yeah, 48.
I don't remember, but it was
Or maybe
a completely
60.
different
It was
times.
pretty high.
The money was expensive, and then you could give it out expensive. And I remember it was I was advertising myself, managing ads in Google, and I was like the only one by a mile. There was like no competition on bidding and all. You can just bid minimums, and that all changed fast.
Yeah.
So I was looking at Capitalia recently. You've disbursed, what is that, 100 million up to date?
Yeah, I think that's sort of like summing it all up, but it's just big round number. In effect, sort of what speaks more of a volume, we fund every month about 2 million of new money. So it's 2 million of loans roughly every month.
A little bit. Can you talk about the differences between, let's say, what you did in terms of the loans to small, medium enterprises, like, let's say, 10 years ago versus now? Because I know you've changed your funding model, how you finance the loans. That's one thing I know. Maybe you changed the focus in terms of who you lend money to. So can you speak a little bit about that?
Yeah, I think it's been quite significant evolution, actually, over time. I'm sure you notice also same thing for your business, but for me it was like that. In beginning, to get money to fund companies, I had to promise high rates, or the expectation was that sort of to get money out of somebody else's pocket, you have to be paying relatively much for it, and so to earn such, we had
so
also.
Who were your investors back then? In the
usually
beginning?
the private investors from Baltic states, friends, extended family, and such. But basically, yes, the sort of cost of money at that point was relatively high, and to earn any sort of margin on that, you had to lend at high rates, and when you lend at high rates, you basically end up lending to perhaps riskier, not maybe all I'm desperate, but riskier sort of situations and cases. And also it was a sort of interesting environment. Basically, there was almost no private money at all. I'm absolutely sure I was the first outside of the banks that did as a business lend to other companies.
Okay.
So, and I think I remained first for 3-4 years. But, lending to high sort of risk situations, and also starting some sort of basically new segment or business segment as such was bound to lead to a lot of mistakes. So what happened was that we got like so many sort of hits in the road and bumps and lessons, and every new country is a lesson, and sort of piled up a lot of sort of learnings, and you become more cautious and more cautious. So basically, become very conservative. And at one point, also I think it was like 2016, 17, sort of competition started appearing in Lithuania mostly, and these guys didn't have this sort of history of burns and mistakes, and they went in all very aggressive. And so in many senses we were sort of started first and became conservative, and then a lot of other guys sort of perhaps sort of surpassed us in at least some products. But it's like what I noticed, it's never a constant situation. There's sort of you wish maybe that there's some stability, but the market all the time changes, and you all the time have to adjust the business. So it's like almost never-ending sort of restructuring, reshuffling, and sort of refocusing. Especially in the sort of, I think, like first 5, 6, 7 years when we were running a business.
Yeah.
And banks started entering this sort of small, medium-sized company financing. There were sort of various platforms, various other competitors that focus maybe on one niche product, and you all the time have to figure out what's your sort of place in this sort of ecosystem. And I think what has happened over time is that we have like very clearly understood what we are good at and how the company has been built up, and understood our niche very well. So basically, it's clear we never want to compete with banks. Outside of that, if there is sort of any situation where bank financing is not sort of useful or not available yet, we are therein. Usually short term, because companies cannot afford to fund for a long period of time with a relatively expensive loan. So we basically solve sort of various short term needs. Usually it's like 12 months, 24 months, maybe like that. And it's sort of in and out, and what we have involved in sort of funding bigger and more complicated deals, which sort of builds on this competence that we have built on, so various procedures, sort of check marks, and how to manage this sort of difficult environment where basically you have to have, at the end of the day, always human decision.
Yeah.
So by design, we didn't build a company where it could be automated and hence maybe scaled easier. We made it harder to scale, but sort of more reliant on procedures and on sort of decisions.
So let's say this is a tailored approach. It has given you some advantage over competitors, the ones in the field, or maybe some advantage to your client in terms of rates or in terms of special situations.
Right. I think what has given it's that there are some sort of niches, especially like sort of deal sizes, 100,000 plus, where we standardized approach, sort of, machine scoring or some sort of very highly automated scoring models simply don't work. It's very hard to do. And we built a system where there are sort of, especially for larger loans, there's very few who can actually compete and provide this on a systematic basis. And that's helped us basically carve out our own sort of position in the market.
What is the, let's say, sector of companies or businesses that would be your client, that would be fit for, let's say, your type of financing?
Yeah. Actually, it's very hard to answer this because we have had, we look at also monitor sort of industry exposures, and there are like all kind of businesses in. It's easily manufacturing, it's easily trade for high seasons, for example, managing flow. It's technology companies managing sort of cash flows. It's really widespread, but the two biggest sectors in each, maybe about 20% of share is trade, wholesale and retail, and manufacturing.
Can you you were talking about lessons that you had to learn through the years. Maybe if you could share some of the lessons that you've learned as a lender to companies, with the context that it maybe some of those lessons could be useful for our investor base. It could be not probably useful. I don't know if those lessons can be kind of like...
No, that is a very good question, actually.
But,
the most useful lesson, that's by, like, I think applicable to anybody. If you lend to your friends or family, you should approach it as you are...
Donation.
You're never going to see it back. So that's a mental state to go.
Yeah.
So if you get it back, it's a surprise. It's a positive thing. But by default, you should assume that you're not getting it back. So that's one of the...
I can
painful lessons
testify to that from my own personal experience. But you're talking about friends, though, and family.
Yes.
You're not talking about legitimate kind of business loans.
Yeah.
Okay.
So where does an acquaintance cross the line to become a friend and a family? That's quite obvious. Right?
Are we friends
Like,
or
who are
family?
we? Yeah,
Because then we could decide whether we pay back or not. But okay. But if there are some lessons that are more business-like when it comes to due diligence or, I don't know, some kind of credit risk management exposures or other things that, let's say, investors that invest in peer-to-peer platforms, of course, they on average don't invest such sums that you do, and they are less sophisticated, but maybe there is some commonalities or some insights that you've learned what to do, what not to do, that could be kind of shared and maybe useful. Question.
Yeah, it's it probably like could be answered for an hour, right?
Yeah.
But I'm just thinking what could be the most important or some of the most obvious ones. I mean, if you talk about lending, for example, to small businesses, that one thing you can absolutely start with is that you cannot rely on almost any financial figure that's provided. I think
Why
you
not?
can trust the turnover figure.
Right.
Because a profit for a small business is very flexible thing. I mean, it depends. Owner pays himself salary, not all the potential cash transactions, not accounting, let's say, sometimes mistakes, sometimes conscious, sometimes unconscious mistakes. There's sort of many ways, and I've seen like probably all of them, how you can game your balance sheet so that it looks nice, but actually if you just dig a bit deeper, there's nothing underneath, debts that you don't write off, inventories that doesn't exist.
Yes.
Cash that does not there in
Suppliers
the bank.
that are like related companies and so on.
Exactly.
Okay, it's a very good point. Is there let's say a threshold of size of a company, or I don't know, some kind of a complexity of a company that the company gets to, where beyond that threshold the company becomes sufficiently professional so that things like that you mentioned are more difficult, and that the investor can rely more on the financial statements?
Yeah.
Let's say, for example, an audit as a kind of...
Audit is a huge sign.
Okay.
So if a company is audited, especially by somebody is not like some one-man show audit company, that's a really good sign. It's not foolproof, but it's a good sign. Another good sign if the company reached the stage where they have CFO. That's another good sign.
As a separate employee, yeah?
Yeah. So if there's a dedicated financial manager in the company, it's a usually good sign that things can be relied relatively highly on.
You don't mean accountant here.
Okay. So audit, CFO. Would you say that there are audit firms that you believe do a better job? I'm not talking about like Big Four versus one-man show, but I'm talking, let's say, second-tier audit firms versus Big Four. Would you say that there is a big difference when you see a company and that they don't have like a PwC, but they have, I don't know, second-tier, third-tier auditor? Does it make a difference for you?
I think we have never financed a company that is audited by Big Four.
Okay.
Big Four is like top 500. That's our client list is exactly everything below top 500 in each of the Baltic countries. So when we do scoring, we have basically 4 categories for sort of how we assign sort of risks for depending on audit. So it's worst is no
scoring
audit.
is what? Scoring of what? Credit risk?
Scoring of credit risk, yeah.
Credit risk,
Scoring
yes.
credit risk. So like worst is no auditor. Second is a sort of auditor, but one-man company somewhere. Third is sort of second-tier audit companies, and there are quite few of them. And I think they are developed from the people that work in the Big Four. And that's usually the clients we receive that are have good financials. So it's like Grant Thornton,
Baker Tilly.
Baker Tilly, some few other names, and then there is Big Four, but those are I think we have never had.
Okay. Okay. So auditor, CFO, and then there's the scoring in terms of where the company sits in with those criteria. Is there anything else? So like, if you have a company that's let's say a loan originator on a platform, an investor wants to assess how trustworthy that loan originator is. They have an auditor, which is second tier. There is no information about the CFO, and the size of the loan originator is, let's say, they do 5 million euros in revenue, and it looks like it's profitable, for example. How would you kind of go about understanding that kind of situation? We're getting very technical.
No, it is pretty technical, but it's
Yeah, gotcha, Juris, gotcha.
No, it's clear. I mean, overall, but let's put it from this perspective. When we score a company, also bonds, and we also have a fund that invests in Baltic bonds, so we have done also sort of adjusted the scoring for bigger companies. Basically, we score about 50 criteria for each company.
50, yeah.
Yeah, and there are various categories. So it's audit and financial data reliability is one. We just when scoring small companies, we just basically don't take into account ratios like profitability and all this. It is basically irrelevant, right? But it becomes relevant for bigger companies. Now, how would approach scoring, for example, this kind of case is look at let's say financials probably get like relatively big grade in the overall scoring. So in this kind of industry, the first obvious thing you get is or look at is debt equity, sort of how leveraged the company is, right? So if the equity is tiny compared to total assets, that's a huge risk factor. That's probably like they have some thresholds certainly that to disqualify if it's
tiny
a
or
small
negative.
Tiny or negative. And there have been many cases, where companies have been tiny or negative equity capital and raising money through platforms, right? And plenty of those experience. But those basically it's absolutely should be a no-go. But that's like sort of obvious sign, and you can just digging deeper is like infinite workspace. Basically, you look at the main drivers, probably loan qualities, what's happening with those, and what do they, how big are the non-performing loans? Are they written off? Are they sold? And when are maturities of debts? How do they finance themselves? Is it sort of long-term financing? Is it short-term? Is it anything approaching close-term? So you dig in relatively deeply actually to do any of this risk analysis.
Just the last question on this line on this topic. Is there any public information on your process of scoring that people can look into, or that, let's say, I as an investor in Capitalia, that I would want to see, like, how do you do your scoring beyond kind of what you described now in a couple of minutes? Something that gives like a...
Or a borrower can go through this list and just, understand, is he eligible or not? Easily before calling you up, simply as that.
Yeah, or that, yeah.
No, we don't share it. It's I think it's one of the core competencies actually, the scoring model, and it took basically 10 years to fine tune it really.
So let's say 50 scoring points, and 30 of them are tied to your personal experience, gut feeling, professional expertise, and things like that. Because this is not something that you could give to anybody as a checklist, I guess. Yeah,
I think the difference as well in company financing, business financing, and personal consumer loans is that the statistics doesn't pay that much overall. Basically, it's very hard or almost impossible for Baltics to gather enough big pool of data to, especially if you find, let's say, larger, especially cases, on sort of that you can statistically say which characteristics on the scoring should be weighting more and what the weights are. So I think the fine-tuning is not only which are the 50 points that we evaluate, is how much weight we assign of them, how do we set their benchmarking, because the number of ratios for and you score very different industries, right? There can be finance company, there can be wholesaler, there can be manufacturer. They have different equity ratios, different debtor creditor days, and you have to put them into some sort of framework, and then we benchmark them against industry averages and all these things. So it gets very, very technically complicated very fast.
let's say an average deal in Latvia, Lithuania, or Estonia for the sake of discussion, besides the loan size and an interest rate and tenor, what would be other terms tied to it? I don't know, collateral, guarantee from the owner, some reporting requirements or something like this.
Okay. So almost in all cases, there's personal guarantee. That's a standard for Baltic business loans. Personal guarantee is there mostly as a disciplined tool so that we are sort of trying to get ourselves ahead of trade creditors and some other creditors who might not have this personal guarantee.
Have you ever exercised rights for a personal guarantee?
Absolutely, yeah.
Okay.
So that's that. Otherwise, the main focus of and sort of also kind of a competence for us is to build is how to evaluate the cash flow to lend against that. So to how to judge that the company is able to pay back the loan, right, from its money cash flow. So we always look at cash flow first and then collateral second. So we have all kind of collateral. We have sort of all kind of experiences on how to lose this collateral, not to be able to find it. So we don't place too much value on it. Basically there's again, various categories of collateral, but real estate is the most obvious one. But businesses usually don't have real estate. They have some sort of assets. Then we have, again, long list of lessons learned where you sort of on balance sheet supposedly see big collateral list, and then when you go in collection there's nothing, or how do you salvage all from that. We have learned not to put much trust in collateral at all, and that's hence biggest focus is really on the cash flow and ability to pay back, right?
Let's say portfolio of online loans, that would be what's good about that type of collateral, or what's convenient about this type of collateral, right? From your perspective as a creditor, because at some point our portfolio was collateral to you as well, right?
Yeah. Remember the days, registering it,
and by essence, it hasn't changed in 10 years.
Yeah. It's interesting. This is a good point. I mean, by the way, one mental side note is, I stepped into this, let's say lending business mostly from previously managing a sort of venture capital fund. So I used to be thinking about companies in terms of opportunities. And then when you become basically start lending to companies, you start thinking a banker thinking, just think about risks. So from this perspective, if a collateral, let's say asset pledge on a portfolio of loans that are short term, there's close to zero value in that collateral, because if the actual collection starts, and there would be other side would be sort of willing to mess with you.
I already feel like this is going to be the part we cut out.
had it on my mind.
If it's a party that wants to mess out, it's very easy to move all these assets, and you basically make it so that you don't get to them at all. Very easy.
I was hoping more something of an answer that there's credit risk and reporting, and then all of those things should be in place, which we have. But you look at it from the completely different perspective, right? Let's say it's a digital asset, and then it can evaporate any time, which kind of makes sense, right? As long as you don't have a tight grip on it from the bank perspective or something like that.
Right. I mean, I think, but then reputation, the background of the sort of the company that originates the loan, that's the one. I mean, you don't. If you've been in the market for 10 years or 5 years, and I know you're solid guys, good reputation, you're not
that's part
at
of
risk
scoring.
It's part of scoring. Yeah. Absolutely. I mean, reputation is huge part. I mean, there are guys who might have beautiful balance sheet, wonderful, let's say collateral, but you look at their history, 10 bankrupt companies, you don't want to touch it because everything sort of ends up in some sort of one way or disaster for creditors, right? So reputation is a huge factor of it, right? But as just looking at one angle of sort of risk scoring, looking at collateral, for online loans, it's not a strong point. I mean, if it would be, even if it's would be, you'll be lending against cars, that would be a bit better, but it's also hard to execute. Sort of collateral, it gets very technical, but basically how do you get your claim rights to that collateral? But it's still better than online loans because those can move very, very easily and quickly, and so on. So there's various categories, but just it's just one angle.
Fine.
Can I change topics on the regulation? So I know you have one or several funds, or like one fund structure that has several sub-funds that are regulated by the local, what is it, FC something, Fuktuk. Can you talk about your experience being a regulated participant in the financial market?
Right. I think from the funds, and we have an alternative fund registration. That's probably the easiest. It's a kindergarten for registration. It's so easy to obtain.
Can you explain a little bit what it means so the people that are viewing?
When you're a fund manager, there are sort of various levels of sort of licensing or that you can apply for, and these various levels give you various sort of powers that you can then exercise in the market. So registration that we have is basically means that you're a registered fund manager. You can sell your funds to informed investors only in this country of registration. So that in our case is in Latvia. It can be only closed fund. So it cannot be sort of open-ended or anything else. And there are various other parameters that we can sort of are limited to.
And that's what your case is?
That is our case. Yes. Now the next level, and basically almost all, I think, exception of one, fund managers are under this registration licensing. Right. So it's widely used in Latvia. Right?
So if you have a German investor, individual coming to you and wanting to invest, you cannot take?
I can take him, but I cannot go and approach him.
Okay. Yeah, you cannot solicit.
Yeah, I cannot solicit, but I can take him on.
Yeah. Okay.
The licensing is the one that's already sort of a European level. So I can license sort of as a fund manager here in Latvia and then passport it in other countries, and then I can go selling in other countries. But again, it's way more complicated. Sort of the complication level is so exponentially higher for fund managers that it's only one has used it so far, and it's a really, really huge fund, right? So,
EFTAN, or which one is it?
It is SG Capital in Latvia. SG Capital, they run a real estate fund, and sort of the reporting and sort of it becomes, and the sort of compliance becomes so much more difficult that only at the scale it makes sense for you to do.
Okay.
In your case, do you have any implications on your actual business side due to compliance requirements, or no, or you can continue running as you would without this, let's say, license?
Yeah, so funds is one side of the business. So we have two funds for venture capital and for bonds, and the core of the business is sort of the one that does the business financing is run as a platform. And platforms now in Europe are under new regulation, and we have to comply to it also by the end of this year. So
that's the crowdfunding services provider?
Yes, that's crowdfunding services provider, and that's a license that we are going for, and basically we have to continue. And
that's going to be in Latvia as well.
Yeah, that's going to be in Latvia, but then it's like sort of it's finally a framework under which sort of operations like ours are to operate, because so far it has been a mess. I mean, especially when you talk about sort of operation in a number of countries, and in Finland there's one law, in Estonia and Latvia there's no regulation. Lithuania is a completely different one. In other countries, maybe there's something else. So you don't know how to navigate all this. So now, at least in Europe, there's a centralized one way, and all the companies that operate in this area have to comply. So, and we can see that in order to comply to this, we already have been doing for the last half year various changes, but the regulation is going to be quite sort of significant burden, I would say.
Okay. In what ways? Like roughly speaking? You're talking about the crowdfunding services regulation. Yes?
Yeah.
It's going to be a burden on you as a business to take the money from the investors? That's what you mean?
No, it's just various more reporting compliance issues to be
dealt with,
right? And then, it's nice this stage, and I'm sure you remember it also very nice when you're just, an entrepreneur, you just, see opportunity, you go jump it, you do it, and it's like
already don't remember it.
You don't remember anymore.
I don't remember anything.
I've heard about it, but
I read in the book. It's a completely different environment. You go and execute, and now it's completely different. You're being put in a box, and you have to sort of live within that framework, right? And then you have to readjust how you work, think, and do other things. So, in a sense, it's hard to imagine it as a benefit. It's more like I see it as a burden, but perhaps it's a necessary burden. Right. It will. I mean, overall, I don't think that this. There was one point in Baltics where there were a lot of fraudulent platforms, and I think that period has passed itself without the regulation. So regulation, I don't think, will clean up, so to say, the system much. It will maybe standardize it. I think it's for sure will sort of simplify, maybe make it safer for investors, but it's a relatively big burden to go through to comply.
Yeah, that's a good point that you said. What market has done to itself. I mean, that I remember the time was when we heard about some fraudulent platforms popping up here and there and then going bankrupt, and that was quite a you had this event a couple of times a year. Now
and there will be still some like lender market and others coming, but there are definitely more in the past.
What is that? Personal assessment, but definitely more in the past.
Well, it's shared by many individuals.
Let's say broadly shared personal assessment. So, anyways, that's not happening due to the fact that the market has regulated itself to a certain extent, which is good. And I totally agree that there's not going to be much benefit from extra reporting, extra compliance on the platform side. We had these topics with Morse, when we were comparing one regulated, one not regulated, and at the end of the day, you understand there's very little difference from the investor standpoint as long as they follow good business practices.
Can you share like monetary cost if you can? If not, then it's fine. In terms of how much cost you will have to incur because you have the crowdfunding services license? Like, what does it mean? Does it mean like, let's say, 2 additional lawyers, AML specialist, and so on?
Yeah, it's a bit hard to judge because it's all internal, kind of. Well, let's say if we would be just running how we have been running, and now what we have to do to comply, I think it's 100,000, maybe even more in costs, because it's all
not one-off. That's what.
No, it's a sort of initially more significant one-off because you have to change the lot of work in IT systems, lot of stuff's happening there. AML we are doing, but it has to be put in sort of standardized framework, which I guess is good, right? I mean, you basically are standardizing the things, but then you have to have a lot of sort of internal policy realignments, changes, then hold this licensing process where you prepare paperwork, send it, correct it, and all this in sort of hours and what you pay for them. I'm sure it's more than 100,000.
Yeah, significant.
Thinking about changing topics, obviously our investor base, they are, unprofessional or semi-professional investors that are taking care of their, let's say, passive income, and obviously they're well-educated about the opportunities. Now, you are a professional financier with extended experience. How do you approach your personal finances, diversification, planning of investments, protection against inflation and things like that?
Holiday destinations,
on a personal level, and obviously, taking into account that our investors will be looking at, what are the things you can share?
I think investing-wise, I have done a whole bunch of it. I mean, various categories. I think it would be hard to name what I haven't done. And generally, my statistics, if I look very frankly on it, is that I start investing like an idiot, and then I smarten up. And going for this talk with you guys, I saw it, and I think my biggest takeaway that I wanted to sort of say out loud is that has been sort of my main conclusion from personal finance management and investing, is that, or almost you can say a religion, that good investment strategy or rational investment strategy is boring. So if it's interesting, you're doing something wrong.
Right. If it's exciting.
That's the conclusion that I've reached. So if you are sort of again, I think I stepped on all of these sort of wrong holes that you should. How is grabicless?
I don't know.
Spades,
Yeah,
spoon.
we got the point.
What you can do, and you always end up as a conclusion. Listen, like you don't go in casino with a rational expectation that it will be earning money. You should
go to have fun.
Yeah, you go to have fun. So basically, the same thing applies for stock picking advice. If you go and start picking stocks, you should be doing for other reasons than thinking I'm going to be the market. But you're like statistically, you're not going to get that. So if you start picking stocks, is it Baltics, is it international, anything else? You should have sort of at least mentally accept that you're doing it for more than just idea that you will earn more, right?
Or you would be, on the contrary, you would be better off investing in an index.
Yeah, absolutely. And that's what I'm saying. Basically, the for investor, retail investor especially, you should be just thinking about passive stuff. So it should be absolutely boring. It's a system that you have created. It's boring as hell, and you just do it and you don't think about it and you don't spend much time on it, right? So,
can you give examples
of
let's say these best options that have worked for you?
Absolutely. So as a sort of mental checklist for boring investing, the first thing is you select your pension fund manager. Some of people are getting salaries and some of that is accumulating this pension fund. So first thing, select pension fund that is running on indexes, lowest fee. Do that once a year. Super boring, super simple. Boom, done. Second thing, and that's where usually I think for most of retail investors things should end. At least in Latvia, there's pretty good state support for investing in life insurance savings products or the third-tier pension fund. So you use that to the maximum. Again, investing in index funds, it basically means that every month you're paying something in a savings, which is with a tax incentive.
Right.
If you can end up so that this investment goes in the index fund, that's basically you are.
But here we're talking about salary deductions. That's your regular salary.
No. Third pension is something voluntary where you pay in every month.
Okay.
Or life insurance for that matter, right? So it's voluntary payment that brings you personal income tax reduction at the end of the year, and you can do it in Latvia for 4K a year. Which is not a lot, but for
up to 4K?
Up to 4K for regular retail investors, that's plenty. And I know that in other countries there are similar programs. And then everything else, if you want to do on top, it's just basic formula index and index. And you can get index for everything. You can get index for international stocks. Very easy. Basically, you can with 2 index stocks, you can make. Two ETFs, you can make a globally diversified portfolio.
Is that what you've done? If we're talking about you, what has worked for you? Yeah.
So basically, I have definitely moved from personal sort of private company stock picking into after burning a bit into index funds. I have a sort of consciously, because I want to experiment and learn a bit more, I don't have a simple index fund structure. I have 15 index funds and various sort of ideas.
Or from the US?
No, it's around the world. It's pretty sort of widespread. With various ideas why and what and why I'm experimenting on this and why not. But basically for most of the people, I would say almost all, 2 index funds is absolutely enough to cover all index investing in shares. The same thing you can do if you want in Baltics. There is significant sort of increasing interest or sort of also in information about how to invest in Baltic stocks. There is this idea about growing of investment culture, at least in Latvia, right? And people often maybe mistake that investment culture means I should be, picking some stocks and then I'll become a millionaire, right? Well, that's could happen. Statistically, that's possible, but
highly unlikely.
But it could happen, and it could be more fun, And if picking stocks anywhere, then Baltics perhaps is a good place because at least you know the companies and feel their products. But again, you can very easily build an index in Baltics, and it's sort of super easy tools how to do this. For example, in Swedbank, there is commission-free trading on Baltic stocks. So basically, you can buy one share and you don't pay anything in brokerage fees, and you can make your own personal index fund and manage it on an easy basis. And for crypto, it's the same thing. Usually, there's no sort of if you want to build a sort of crypto, instead of picking out, do I invest in Dogecoin or anything else, just have a program, invest in sort of capitalization-based indexes. That's it. Relax. Apart from just doing the passive, another thing I think it's important is to understand that you're never going to find the best timing, right? So it's unlikely that sort of sun shines on you in a special way and you find exactly the right time to buy something at the bottom. So best approach that I can recommend and I use myself is that you just have a sort of monthly or a quarterly investment program. And you just, every month you invest this amount and that's it. And market is sometimes up, sometimes down. But if you look at it long term, and that I guess for investing anyways is the only way to look at, it doesn't matter, right?
Can you, a little bit going back to peer-to-peer, I think I remember there was an event, some kind of a fintech event in Latvia where you were on the panel talking about some statistics that you were analyzing for, I think it's an Estonian peer-to-peer platform. I don't remember. Maybe you don't remember either. But the question is, you have invested also on peer-to-peer platforms, right? Can you share some kind of background in terms of how was your thinking when you invested in these different platforms? Because we've been talking about loans to SMEs, we've been talking about your passive investment strategies, but as far as your experience with investing in peer-to-peer, in platforms similar to ours, what has been your, I don't know, maybe there are some lessons and maybe things to look out for from your experience?
Okay. I think with regards to sort of peer-to-peer platforms or loan marketplaces, one thing that stands out is I don't believe in need for diversification in a sense, at least among the platforms, right? Each platform works in a different way. They have completely different sort of interface, menu, system, how you buy things, sell things, manage things, report taxes. So if you add 10 platforms, it just creates crazy amount of complexity for you. I think the time spent on it just doesn't justify the cost.
Which I think, sorry to interrupt, which I think most of investors we know from, let's say, our Telegram, they do exactly that. They have at least 3 or 4 different platforms.
For some reason, this is popular. It's
I would rather say, you focus on one, do really thorough due diligence on them, and just do work with that. Because at the end of the day, the product that you get, usually for platforms, is exposure to consumer loans, right? Yeah. In one way or another, it's basically the same. Yeah. Geography is a bit matter, but what does it?
The same type of risk.
Same type of risk. So it's the same type of risk, same type of amount in sort of your target portfolio. I think it's just in this case. It's same like you select a stock brokerage that you work with, right? It makes no sense to open account in Swedbank, Interactive Brokers, bit in Revolut and bit there, and then just manage this, right? It's stupid, I think. Right? So you just select one and you work with that. And I think the same with platforms.
Makes sense.
You had this. I remember we were talking back in the day on your personal note. You had this situation with picking stocks, Chinese stocks, which didn't go that great.
That one I haven't heard. Chinese stocks, really? Okay.
So it's how one sits at the table in Riga and comes up with okay, I'm going to invest in Chinese stocks, and then starts picking stocks and obviously everything around it.
Not sticking to your own first rule, which is boring.
Absolutely. That's what I'm saying. No, sometimes these lessons, you read them in a book and they don't stick to you. You have to do it yourself so that you understand. But basically my thinking went like this, that at that point, American stocks seemed overpriced. And I actually...
When was this?
I think the Chinese experiment started in early 21. I looked at the sort of stock market. I have actually a model. I try to value it. I think myself as a value investor, I just, it's crazy amount of time you can jump in there and do it. Basically, I have a model. I sort of put a little bit of valuation on these companies. I look at some of the companies in USA, and it seems like crazy. You remember after COVID, everything went up. It was like, America. I sell everything in America, especially some of the things that are now skyrocket high, like Occidental Petroleum and some other things. Anyways, basically, the problem is I'm looking at America. It seems like super expensive. And then in China, they started some sort of bad news circulating, this various tech regulation crackdowns, and there were like multiple levels of them.
Expecting market melt.
So real estate, crash coming.
Real estate crash. And basically, there was like one bad news, and there was second bad news. Second bad news. I think buy low when everybody's afraid. I mean, that's a common phrase, right? So you look at these things. Oh well, look at my valuation model. Everything looks like amazingly cheaply. 50% discount. So I built a portfolio of American, Chinese stocks. Alibaba, Tencent, very smaller things. Bad news just keep coming. I mean, it just goes down,
So you were thinking you've reached the bottom, but that was just
that's my bottom. But I know this stuff. Of course, things go down.
I should buy more.
I buy more. And that's exactly what I do. And if things go down 20%, I buy more. And things go down more 20%, I buy a little bit more. And then they go
less, more. A bit more, but less more.
Yeah. And then they go even more down and think, fuck, I mean, this is it's crazy exposure. It's way more than ever wanted. It's going way down. And there was a point when average sort of minus in the portfolio of supposedly diversified portfolio in Chinese stocks, which is basically bullshit diversification, it was like minus 50. And I mean, some are like 80 something and some are just...
But it was individual stocks, not some ETF.
I know. And then I thought about this and I figured, that's really stupid that I've been doing. Obviously, right? Trying to beat the market and ending up in that. Also, supposedly I thought it was sort of, short-term relative investment because, it's just a matter of time when Chinese stocks, with beautiful Chinese economy are going to catch up to the levels of valuations in states and such. So, for sure, it just, it seemed like click that, sitting here from Latvia, I know nothing about this. I think I never been to China, so I don't know nothing. I mean, about this environment.
You remembered about
it's ridiculous.
About after your portfolio dumped 50%.
I've never been to China. Actually. Why?
These realizations and then you become, and it's okay. That's really stupid. And basically, at the end of the day, I have switched. I mean, I have still exposure in China. I switched maybe to sort of, let's say, longer term thinking. I will not sell them. I'm not sort of. I don't have to need to do this.
But you didn't sell then.
No, I didn't sell.
Okay, that was my question. Right. So you
I think through them
all of the positions. So have they recovered from?
Yeah, and actually, especially this year has been starting very well. They recovered relatively. Honestly, still not pluses, but it's not a huge minus. It's not painful to look at so much, at least. And at some point, I understood that this picking of stocks is pretty ridiculous. And at relatively low valuation, I went into there's a bunch of beautiful ETFs that specialize in Chinese technology companies. For example, I bought some of these indexes, and they have sort of been on very good pluses lately. So, in a sense, again, it's retrospectively, it's very stupid, but it's and you know what? It's actually why I did this, because I did the same analysis for USA stocks in 2020. And obviously, I think you could have like thrown a dart in the wall and picked a stock and it would have gone up. Yeah. But on this success, you earn some money. Oh, it's so easy. It's like it comes. You just pick something.
You're smart.
All right, maybe I actually know something. Maybe my valuation model is such a beauty, solid. Right? It's solid. And of course, it's not. And if it's cheap for a reason. That's another thing. So I don't know. I think it's an amount of time and sort of it gets very addictive.
Yeah, emotional.
It's emotional moment. You start checking these things, and it's really stupid in a sense, right? I mean, this passive investment, boring. You don't check the stocks. It doesn't matter. You have a long-term plan. Invest every month, fixed amount. Forget about it.
Yeah.
Nice, good. Well, yeah. On a personal level, that's I think.
Maybe last question. What about your plan for this year in terms of business? What's your focus? What do you want to achieve?
We really want to focus a lot in Latvia. We have sort of always had this sort of a little bit of feeling, although we work in all Baltic countries, in Latvia we have the strongest position, but it sort of never has been sort of best market. We never had sort of full focus on it. And this year we'll be focusing on just growing the Latvian business side. We want to reach out to more investors to tell them about our sort of, I think, beautiful investment products, how to get exposure to Baltic countries. We want to reach out to more companies to understand more of sort of how this alternative financing works. And that's sort of another thing that, companies just lately start to understand that there is not only, bank financing or no financing, there are other means. Yeah. And we want to educate and tell more about this. And
is it still like a thing where people need to be? You're talking about educating who? The clients, the companies, or the companies? The companies.
Yeah.
They still need to be educated
absolutely, absolutely. I mean, they don't know all the tools in the arsenal, and you can understand. I mean, from their perspective, it's a bit sort of it's unclear, this world, right? I mean, bank is very sort of long concept. They have seen around it and know around it a lot, but they don't know what else is outside there. And at first glance, it might look very complicated. There's funds and investors and platform and alternative lender and Altum and support programs, and how to navigate this is not simple. And that's what we want to do, is like sort of provide some tools and help in how to navigate that market and how to
and sorry, in your average
menu
tickets that you're looking to lend are how much?
Average is around 100,000. So the full range is from 25,000 to, let's say $1 million. Mm-hmm. So that's typical our scope.
Makes sense. Best of luck with that.
Thanks.
Hope to grow or double your portfolio in following years.
Yeah, doubling is easy. Lending is easy. Getting money back is hard.
So we've heard.
This is something we've experienced.
All right, let's
call it today.
That's a wrap. All right,
Thank you, guys.
Thank you.